Hello, welcome back. So at last, we on to the last class for this reading. Wow, it's been a long reading, but we nearly there. So let's hang in there and we're going to make it. So we're now moving on to correlation between two variables. So what is correlation? It measures the linear relationship between two random variables. But before we get into correlation in more detail, we're first going to take a look at sample covariance. And that's given the symbol S, and the X is for variable X, and the Y is for variable Y. So what this does, it measures how two variables in a sample move together. So that's why it's called covariance. How do they move together? Now, I don't want anybody to panic about this definition over here and even this horrible looking formula here, because we don't have to know any calculations. We just need to understand what this is, and it's not as bad as it looks. If we break it up, we're going to see that. So what is this thing? It is the average value of the product of the deviations of observations on two random variables from their sample mean. So we're going to go to the formula and then we'll come back to all of this wording over here. So to work out, and as we said, no calculations needed here, but if we had to calculate it, to work out the sample covariance between X and Y, what we're going to do is we're going to take how is the return, let's call it the return. How is the return on variable X deviating from its mean? Because we're looking at the deviations of the two random variables from their means. So, but now we're not just looking at one variable on its own. We also need to take into account how is the other variable deviating from its mean. So then we've got the other variable, which is y. Let's say it's the return on y, and we see how is that return on y deviating from its mean. So this, for example, could be for year one. Now, what we need to do is to take all of these deviations for each and every year. So how is X deviating from its year? How is X deviating from its mean in every year compared to how is Y deviating from its mean in every year? So we're going to do it for year one, year two, year three, however many years there are. So that's why we say over here, we're taking the product of these deviations in the numerator, and we can see here again that we're going to then sum up all of these deviations in the numerator, and then it says here we're going to take the average value of these deviations, and that's again why we divide by n minus 1, just like we did with the variance. Remember the variance? This is now very similar. So instead of having variance, we now got covariance. So I'm going to come back to the variance formula in just a minute, but I just want us to have a look at this block over here. So if the variables are returns, the returns would be returns squared, because we're squaring here just like we did with the variance. Remember with the variance, we took each and every year's return, we took each and every year's deviation from the mean and we squared it. But now we are also having a square because we're multiplying the one by the other. So in actual fact, as I was hinting, this formula is very, very similar to the variance. So what I'm going to do is, if I circle this here, what have I just circled there? That in actual fact is very, very similar to the variance, which we do for just one variable. And remember, for the variance, all we had here was we had this deviation squared. So the only difference now for covariance, we're looking at two variables. So we're taking the deviation from the mean of X, and we multiply that by the deviation of from the mean for Y. And if we do that then for each and every year and sum up all of those deviations. Right, so we are going to do an example on the next slide, which will clear this up, even though we do not have to do any calculations for this LOS, but the next slide will just help us to understand what's going on here. So this is the important part that we need to know for the exam. So covariance, it's positive when the returns on both variables tend to be above or below their means at the same time. So if that's the case, we're going to get an average positive relationship between the returns. So for this bullet point, I want to come back to it after we've done the example on the next slide, and then it's going to be a whole lot clearer. So then the covariance, it's negative when the return on one variable is above its mean. So let me start again, sorry. Covariance is negative when the return on one variable is above its mean. The return on the other one is below its mean. So here, if that's the case, we can have an average inverse relationship between the returns, and that's going to be negative covariance. And then the covariance is going to be 0 if the returns on the assets are unrelated. And there is one problem with this covariance because it ranges from negative infinity all the way to positive infinity. So in other words, it is difficult to interpret. And it does not indicate the strength then of the relationship between the two variables. So what does indicate the strength between the two variables? It's going to be the correlation, which we're going to see in a few minutes' time, not the covariance. The covariance does not indicate the strength of the relationship between the two variables. Right, so we'll come back to that point in just a minute. But let's try this example, and I've put our note here for us that this is only for illustrative purposes. As I said, there's no calculations required here, but let's have some fun anyway. So what is the sample covariance of returns for stocks A and B over the following period? So we've got a 3-year period here. So step 1, what we need to do is work out the mean of both stocks, because what are we trying to do here? We're trying to see how these two stocks are deviating from their mean in each and every year. So if we work out the mean of stock A, we see it's 7% there, and the mean of stock B, it's 5% there. So now the covariance, what we got to do for each and every year, we got to see how are these two guys deviating from their mean. So let's do it for year 1. So let's call it 2018 year 1. So it was 6% return for year 1 for stock A, and its mean is 7%. So it's deviating there by the 1%. And now remember, what's the deal? We got to multiply that by how is B deviating from its mean in the same year. So in 2018 or year 1, B did 5%, and its mean is 5%. So there was actually no deviation for stock B in the first year. So let's just call that, I'm going to call that 1 there for year 1. Then we got to now do it for year 2. That's 2019. So how is A deviating from its mean in 2019? Well, it did in 2019, stock A did 10%, and its mean is 7. So it's deviating there by 3. And then what about stock B? Well, it did 7%, and its mean is 5. So it's deviating by 2. And then for year 3, what is the deviation looking like? Well, that's the year 3 is 2020. So then stock A did 5%, and its mean is 7 over there, 5 and 7. And then stock B did 3, and its mean is 5, right? So there's stock B is deviating there by the 2% in year 3 or 2020. So remember the deal, we got to add up all of these deviations. So I've added up the deviations there, and then we divide by the number of observations we got, or number of years that we have. We've got 3. We got 3 years there, less 1, and that's going to be our covariance. So we can see it's a positive number. So all we can then really say, we can't, this doesn't tell us what the strength of the relationship is between the two, but all we can say is this. And as promised, we are now going back to the previous slide. We have a positive covariance in our example. So this means the return on both variables tend to be above or below their means at the same time. There's now an average positive relationship between the two. So let's just say it again. The returns on both variables tend to be above or below their means at the same time. So let's check if that works. Well, for year one, A is the, so this is A over here. This is stock A, and that is stock B over there. So for year one, A is below its mean. The return for year one was 6%, and its mean is 7. And B is the same as it means. So that's what we can say for year one. But look at year 2 and 3. Year 2 and 3 are tying up with what the previous slide is saying, because in year 2, which is 2019, A is above its mean, and so is B above its mean. You see there, A is above its mean. It's 10. The return in year 2 was 10, and the mean is 7. And for B, the return in year 2 was 7, and its mean is 5. So they're both above their mean at the same time. And in year 3, you're going to see that both of them are below their mean at the same time. So in year 3, which is 2020, stock A did 5% and its mean is 7, so it's below its mean. And stock B is also below its mean because it did 3% there in year 3, which is 2020, and its mean is 5. So they both are below their mean in year 3. So other than year 1, it's all working out, because it's, we remember on average here, if we got a positive number, when A is above its mean, B is above its mean. When A is below its mean, B is below its mean. So B is below its mean. So on average, that is the scenario. Good. So that then is definitely, that this little example, even though we don't have to do calculations, helped us to understand what's going on. Right. So now that we've covered the covariance, we can now go on to correlation in more detail. So we're going to look at the sample correlation coefficient, which is given the symbol R, and X again is for variable X and Y is for variable Y, the correlation between X and Y. So what is correlation now? What it is, it's a standardized measure of how two variables in a sample move together. So it's now standardized. That's the big difference, because with covariance, we were just looking at how two variables move together. But now with correlation, it's a standardized measure of how two variables move together. So how do we work it out? It is the ratio of the sample covariance. So we're going to start with our covariance that we looked at on the previous slides. So it's the ratio of that to the product of the two random variable standard deviations. So here it is over here. So we've got the sample variance, we've got the sample covariance in the numerator, and we divide that by the standard deviations of our two variables. So that's why it's the ratio of the sample covariance to the product over here, the product of the standard deviations of X and Y. So we got the standard deviation of X there multiplied by the standard deviation of Y over there. So what's important for us to know is that the sign of the covariance that was from the previous slide, that determines what the sign is of the correlation. Because if this is a positive number, then the correlation is going to be a positive number. If this is a negative number, if this sample covariance was a negative number, then the correlation would be a negative number. So again, I've got a note here that we don't have to do calculations, but the correlation calculation is a million times easier than covariance. So we'll see it's not so bad. So they've given us here the covariance of returns between stock A and stock B. It's 0.0008. And the standard deviation of stock A, it's 2.91%. And the standard deviation of stock B is 2.8. So what is the correlation of returns between the two? So all we got to do is take the covariance there in the numerator, and we divide that by there, the product of the standard deviations of the two stocks. That's the standard deviation of stock A there and the standard deviation of stock B. So that then is our correlation. It's 0.98. There's a 0.98 correlation between stock A and stock B. So now let's investigate this correlation in more detail, because it's a very, very important number. So what does it do? As I was alluding to a little bit earlier, correlation, it now measures the strength of the relationship between the two random variables, whereas the covariance didn't. Covariance wasn't measuring strength. It was just telling us covariance. All the covariance was doing was what? It was telling us whether we have a positive or a negative relationship. It didn't tell us what the strength of that relationship is, because we had that range from anywhere to anywhere, basically. Now we've got something where we can tell the strength of the relationship between the two variables. So and the correlation, it's got a range. It's only from -1 to +1. It can't be beyond that, whereas our covariance could be anything. So if the correlation, if it's close to -1, that's going to be a strong negative, which means an inverse linear relationship between the two variables. And if it is equal to -1, if the correlation is equal to -1, then we've got what we call perfect negative or inverse correlation. So this means that if A goes up 5%, then B will go down 5%. And then if it's close to +1, then we've got what we call strong positive linear relationship. And if it's +1 exactly, if it's +1 exactly, that's what we call perfect positive or direct correlation. So this means if A goes up 5%, B goes up 5%. If A goes down 5%, B goes down 5%. And what happens if it's nothing? So if it's 0, then there is no linear or straight line relationship between the variables. So the closer the correlation is to 0, the weaker the relationship. The closer we are to -1 or +1, the stronger the correlation. If it's negative, then it's negative correlation. If it's positive, then it is positive correlation. And lastly, we can see correlation, it's got no units. So why is that? So if we just go back and have a little bit of fun over here, we know that the covariance, or if we think of like we spoke about with covariance here, we had percent times percent over there for covariance. So we've got in the numerator here percent squared. So we can put it in like this. We've got percent squared then over there, just like we had with variance when we did variance a few classes ago. And then our standard deviation is in percent. So we've got percent there multiplied by percent over there. So this means that that percentage squared is going to cancel out those two. So we have got no units with correlation. We only go in this range from -1 up to +1, no units. Good. So the last thing we need to look at now are the scatter plots. So we have looked at scatter plots briefly when we were in one of the other classes, but now we're going to go on to them in a little bit more detail. So we've seen this before. A scatter plot, it's a graph that shows the relationship between two variables. So if we start with this one, where we've got a perfectly positive relationship, like we said from the previous slide, then the correlation, it's +1. So we can see over in this graph here that we've got advertising spend in millions of dollars on our x-axis, and we've got our sales, which is also in millions of dollars, on the y-axis, which is our y. So sales is our y variable. So we can see here that when the x variable, which is our advertising spend, increases here by 1 unit, it goes up by $1 million at a time. We see that the y variable, which is our sales, that increases by 10 units at a time, by 10 million at a time. So in other words, these two are moving in perfect lockstep. So we can actually draw here, if I can do it correctly, we can draw a straight line through these dots. So there's a perfectly positive relationship between the two. So if we can draw a straight line, or let me say it again, if we can draw an upward sloping straight line in one direction, then we've got a perfectly positive relationship between the two. And then, of course, if we've got a perfectly negative relationship between the two, as we said on the previous slide, the correlation is going to be -1. So in this case, we can also draw a straight line here between the dots going in one direction. That's supposed to be a straight line. So if we've got a straight line in one direction and a sloping downwards, then we have got a perfectly negative relationship between the two variables. So in this example, we've now got interest rates as our x variable, and we've got mortgage applications at the bank in thousands here, along as our y variable. So we can see now that when the x variable, which is interest rates, when that decreases by 1 unit, so if we start here at 5%, and if interest rates start dropping now, we can see that as the interest rates go lower, the mortgage applications at the bank increase. Say so we go here from 2 to 1. At 2, when interest rates are 2%, there were 40,000 applications at the bank, because we're measuring in thousands the number of applications. But when interest rates go down to 1%, then there are 50,000 applications at the bank for mortgages or home loans. Why would that be the case? Because if interest rates are lower, then it becomes more affordable for people to be able to qualify for a home loan, or housing becomes more affordable. So then there's going to be more applications in the bank, the lower the interest rates go. So again, we see here that we're moving in perfect lockstep. If the one goes down 1, the other one is going up 10. Right, so that takes care of that. Now, what about no linear relationship between the two? If we've got no linear relationship between the two, then the correlation is 0. So for this example here, let's look at this dot over here. When x was low, so was y. Y was low. But in this scenario here, x was big, but y was still small. Okay. So we've got a huge difference there between the two. And in this one over here, when x is big, y is big for this one. But over here, when y is big up here, x is small for this one. So there's no linear relationship between the two. We can't draw any type of a straight line between these dots. And you might remember from, it feels like many classes ago now, remember we looked at the relationship between the returns on the S&P 500 and I think it was the real estate index. It looked something like this. There was no linear relationship between those two variables. So you can just go back there and you'll see that's the example that we looked at. Now, for this last one, we've got a non-linear relationship. And if we've got a non-linear relationship, then again, the correlation is going to be close to 0. So we can see why it's non-linear, because even though it's a straight line here, It's not a straight line in one direction. To have a relationship or a linear relationship, the line has to go in one direction. So here the line's not going one direction, so we cannot have any type of relationship. So our correlation is going to be close to zero. It's a non-linear relationship, this one. So this, what we can see here is that the non-linear relationships, they are not described by the correlation coefficient. That's a rule for non-linear relationships. They're not described by the correlation coefficient, but X and Y, they are related in a predictable way. So how does that apply to our example? Well, we can see they are related in a predictable way. Why? Because when X is below 5, we see that as X goes up, Y goes up. But as soon as X is more than 5, as X goes up, Y goes down, right? So therefore we can see they are not related in a predictable way. So what I've got over here is actually going to be the next point on the next slide. So the next point on the next slide we have covered, but let's just do it again, just so that we can be sure. This slide is talking about limitations of correlation analysis. So this is what we've discussed. Non-linear relationships, they are not described by the correlation coefficient. So that's one problem with this. The non-linear relationships, we cannot, they are not described at all by our correlation coefficient. And also one limitation of correlation is that correlation, it may be unreliable when our outliers, our extreme values are around. So what we need to do is we must determine whether correlation changes greatly by removing the outliers. So here's the deal. If the outliers contain information about the relationship between the two, then they should be included in our analysis. But if the outliers, if they contain no information about the relationship between the two, then they should be excluded in our analysis. And how do we do that? We need to go back to a few classes ago. Remember the trimming or the winds arising. That's what we can do to exclude those outliers. Right. And then another problem with correlation is that, or a limitation, or I should rather say, it's not a problem, it's a limitation. Correlation does not imply causation. So one does not necessarily cause the other. So we don't know whether A causes B to move or whether B causes A to move. What we can say is that correlation, all it does, it implies association. That's what we must know. Correlation just implies association between two variables. It does not imply causation. And then lastly, the correlations, they can be spurious. And this means the correlation, it misleadingly points towards associations between variables. So we're going to look at 3 instances of spurious correlation. So instance number 1 is correlation that is the result of chance. So I saw a good example once, I read a good example once, where there was a scenario in a state in America that very, very often when it snowed, the stock market went up. So that is just correlation as the result of chance. So we shouldn't use that, to make an investment decision. So whenever it snows in that certain state, we should go, and invest in the stock market. So that is correlation, that is the result of chance. And then the next instance of spurious correlation is this one. We can get is correlation that's induced by a calculation that mixes each of 2 variables with a 3rd variable. So, for example, 2 variables that are uncorrelated, they actually may become correlated if they are divided by a 3rd variable. So something like that can be a problem. And then then the last instance of spurious correlation that we can have is where correlation between two variables, it arises not from a direct relation between them, but from their relation to a third variable. So let's take an example like this. Let's say we've got two gold mining companies that are trading on the stock exchange. Now, these two gold mining companies, they have got very, very different financial statements. So we'll talk about the financial statements in a lot of detail in financial reporting, but let's say we've got the income statement and the one is making huge profits, but the other one is making losses. The one's got a very strong balance sheet. So, you know, it's debt equity is in a very good position as assets are very strong, and the other one's debt is very high compared to its equity. So they are very, very different, but because they are both related to a third variable, which is what? The gold price. Okay, that gold price, that is the main thing that drives the returns on the shares. The financials play a part, but that third variable can actually be the thing that's driving the relationship between the two. Good. So that then is the end at last of this very, very long reading, but just all we need to do is study hard, put those hours in, practice all the questions, do all the CFA Institute practice problems like we've been saying, practice other questions, and then we're going to be fine. And if you need anything or got any questions, let me know and we'll help you out. And otherwise, we'll see you then in the next class. Hello, it's Tim here again. I hope you enjoyed the class and found it beneficial. We have some classes available for free on YouTube, but we have classes for the entire curriculum. The classes that are not on YouTube can be purchased from us. If you'd like to purchase the classes, please contact us for the pricing, and I've put our contact details over here. You can purchase all the classes or certain readings that you would like. When you purchase the classes, we provide you with the slides and our notes. I've assisted hundreds of candidates pass CFA exams, and I look forward to also helping you through the CFA program. I've put in 2 testimonials in the slide over here, and we also have a testimonials page on our website that you can review. I look forward to seeing you soon, and all the best.